Our paper, Fundamental Growth, should be of interest to anyone in the investment business who chooses to invest in a dedicated growth portfolio, or anyone in the academic finance community who wishes to better understand how growth investing can and should function. Both the academic and practitioner finance communities have long embraced a binary duality that what is not value is growth, and what is not growth is value. The bizarre element of this is that relative valuation is deemed to be equivalent to growth. That is to say, if it's cheap, it's value. If it's expensive, it's growth. Our view is very simple. If it's cheap, it's value. It'll include a lot of value traps and undesirable value stocks, but yeah, cheap is value. Expensive is expensive. Expensive is not growth. So the essential component of our work is to recognize that it makes sense to identify growth stocks based on growth, not based on relative valuation multiples. The second element of our work that's important is fundamental weighting. Both of these borrow from Fundamental Index, which we published in the Financial Analysts Journal 21 years ago. Fundamental Index takes the notion that you can choose companies based on how big they are, their macroeconomic footprint, and weight them on how big they are, their macroeconomic footprint, not based on market capitalization. In so doing, you're going to have a value tilt. You'll downweight the growth stocks, you'll upweight the value stocks, and you'll do so in a fashion that mirrors the look and composition of the macroeconomy rather than the look and composition of the stock market. But RAFI also has a rebalancing alpha. If a price soars and the fundamentals don't validate that price move, then you're going to contra-trade against it. And if the fundamentals continue to not validate that price move, the price move is likely to mean revert. Well, applying this same idea to growth is very simple. Would you use the fundamental size of a business to choose growth stocks? Of course not. Would you choose the percentage growth rates of a company to choose growth stocks? Well, that makes all the sense in the world. Growth in what measures? The obvious ones are sales growth and profit growth. Less obvious, most growth companies break out R&D as a key component, a key measure of their P&L. Why not, for those who do break it out as a separate item, also track the rate of change of R&D spending? Growth companies will have rapid growth in sales, should have rapid growth in profits, notably top-line profits, cash flow. And if they break out R&D, should engage in increasing spending in R&D. Well, these are very self-evident choices for selecting growth stocks. As for weighting growth stocks, would you want to weight them based on their economic footprint, the size of the business? Of course not. That gives you the value tilt that RAFI, the Fundamental Index, is famous for. Why not weight them based on the dollar magnitude of their growth? Take at the top end of the Fundamental Growth Index, the two companies that get the biggest weight today, Apple and NVIDIA. These companies have dollar magnitude sales growth in the last 5 years and dollar magnitude profit growth that for each company is roughly 10% of the total growth in the US economy, the total growth in sales and profits of publicly traded US companies. So choose the stocks based on the percentage growth rate, weight them based on the dollar magnitude of the growth so that you're mirroring the look and composition of the growth engines of the US economy. From an academic perspective, the implications of this research are equally important. We're calling into question, we are challenging the fundamental notion that relative valuation is a basis for choosing growth.